Afternoon, everyone. My name is Robert Rayburn, as I'm sure most of you know already, and I have our Chief of Compliance for Simplicity Wealth, Scott Rader, who's also joining us today. Now, we've been trying to do this every month, the first Monday of every month, as we know that we had Labor Day last weekend, so hence we're doing it the second Monday of September. But we do have a lot to go over. Unlike the market update, really these presentations are designed to be more about practice management, what's working on the marketing side, what's not working, doing a little bit of market stuff just because that is part of your daily routine, and then having that compliance overlay, because one of the biggest things that we see with advisors these days, those ones that are successful and able to really scale their practices, they got the compliance all buttoned up. And that's really what Scott's here to help you do. When we go into whether that DOL passes or doesn't pass, one of the things we know for certain is that regulation is increasing. And so, Scott's really here to help guide us through the weeds of all that. And, better him than me. That's all I'm going to say. So, without further ado, we'll go ahead and get the presentation started. I'm going to share my screen here, so if I have any technical difficulties, I'll apologize in advance. But see here. So the agenda for today is we're going to do three things. Real quick market update. I don't want to spend a ton of time on it. We did send out a market update earlier today. We're going to focus mostly on market conditions. Now, we do have tactical strategies, the income, the opportunity, the blue chip, all that stuff. That's a separate update. This is more about advisor practice management. Number two, how do we use interest rates to close business today and tomorrow? We had a record-setting month production-wise, and what that means is our advisors had a record-setting production month in August. So we couldn't have done that without our advisors. And a lot of the ways they did that was to talk about how rate cuts are coming and the economy is slowing. And there's a great opportunity to lock in some of those higher rates for the foreseeable future. And then for annuities cases, for the rest of your life. All of that said, we got to be really careful and cognizant that we're not getting all that excitement built up. The Fed cuts rates, and then people assume that there is no longer a market out there for annuities or bond market strategies. So what we're here to walk through today is that we're just at the very early stages of the rate cut cycle, and how do we walk clients through that to make sure that, hey, if a client didn't quite pull the trigger back in August, they see the action that was taken by the Fed in September, they see rates starting to drop. Oh, wait. Hey, Tom was right about what he was talking about back in August. I better recircle back and make sure that I do exactly what I thought I should have done a month ago. And then lastly, of course, we'll do that compliance update with Scott leading the way there. Real quick, September, and it's almost like it's Groundhog Day again. And if it feels like September is a crappy month for the market, quite frankly, that's because it is. And historically, when we look at the historical performance of the stock market, in this case, we're using the Dow Jones, which is not my favorite index to use, but it does have the longest historical track record. We go back to 1896 for the Dow Jones. There is one month that stands out like a sore thumb, and it is the month of September. And why does it happen in September that bad stuff happens? Who knows, right? There's the explanation that everyone is off for the summer and any sort of bad news that has accumulated percolates and shows up in September when people return back to work. There's that explanation of it. Quite frankly, there's just been, I think, coincidences that certain events like Lehman Brothers have occurred in September, and then you get the psychology. Oh my God, September's coming. I need to start to pare back risk, and it becomes a self-fulfilling prophecy. Terrible week last week. Stock market fell 4 or 5%, depending on the index that you're looking at. One big reason is the jobs report on Friday. Believe it or not, the jobs report was pretty good. 145,000 or so jobs that were created. That's not a bad number. When we were in 2008, before September even happened, there was about 8 or 9 months of negative job growth in the U.S. So I want to be really clear, given the job growth we've already had, 145,000 was pretty good, but that was the problem. People were looking for 50 basis points of rate cuts in September, kind of hanging their hat on that. And then guess what happened? That takes a chance of a 50 basis point rate cut from 65% all the way down to 27.5% right off the bat as soon as that report came out. Again, we're in the camp of we don't care if it's 25 or 50 in September as long as the rate cut cycle begins. And the other big question, recession or soft landing. So you can get all of this right, but if we go into a recession, we're going to go into more than likely go into a bear market. Now, the good news is that most of the data continues to point toward a soft landing. So this is just a broad index of different economic indicators that we look at, whether that's non-farm payrolls, manufacturing PMI, the FOMC rate decision, inflation, yada, yada, yada. You can see here, the vast majority of the data is coming in tame, right? Before we had some hot numbers that were coming in as a result of runaway inflation. That has cooled down. The economy has cooled down, but we haven't seen that contractionary data or anything in the pipeline of that data to suggest that we're getting anything contractionary in the near term. Now, could we be dead wrong and the economy falls off a cliff in the next 3 or 4 weeks? Sure, that can happen. But there's nothing in terms of the evidence or in the data that suggests that anything nefarious is right around the corner. Biggest thing I could say just anecdotally is the way the bank stocks have been acting and everything. It's just not, they're one of the leaders in this market, not something you typically or traditionally see ahead of a recession. So right now, overheated economy appears to be cooling, but does not appear contractionary. And this gets us back to one of the biggest advisory practice points that we all need to make as advisors when we're coaching clients. It really is, and this doesn't matter if you're using a tactical strategy, doesn't matter if you're using a passive strategy or some strategy from Timbuktu. It just doesn't matter. At the end of the day, the biggest thing that leads to performance for clients over the long period of time is time in the market versus time in the market, right? And I think that this little drawing here on the left says it best. The last 5 days have looked a lot like this, but if we look at the last 5 years, have looked a lot more like that. And the percentage of occurrences that look a lot more like that left drawing over 5 years versus the 5 days is probably in the 90% and above range. And we know that the biggest thing that hurts clients is missing some of the best days in the market, which often occur right after big market sell-offs. We can see here, and this is a chart we've used in the past, is that if you invested $100,000 going back to, I think in this case it was 1987 or so, that grew to $462,000. I think this is actually going back to 2010, pardon me. You just take out the 10 best days over the last decade, not of the year, but the last decade, that 462 goes all the way down to 257. You miss the 30 best days, that's down to 151,000. And if you just missed the 51 best days over the last decade, you had a negative return. So it's really important, if there's one basic lesson that we can coach clients on, is that no matter what social media says, no matter what the news media says, stay in the market unless you need the money over a short period of time. It's one of the biggest lessons that advisors can deliver, and it's one of the biggest value adds that we can offer as an advisor. And that's really where, at the end of the day, when you're trying to explain what does an advisor do versus a portfolio manager, we fundamentally believe that an advisor is not a portfolio manager. An advisor is a coach, is a financial swing coach, right? We believe that you, the advisor, are the number one thing that stands between the client and making that big mistake of panicking and pulling out of the market right before the market bottoms and starts to recover. It's about the financial goals. It's about putting a plan to reach those goals, looking at the different types of products and concepts that are out there that match those goals and risk tolerances, and then adjusting it over time, right? You know, clients, their risk tolerances are going to change. Their goals are going to change. Maybe they meet some goals and they have new goals that enter into the picture. That financial goal process is an organic process. It's not a, hey, here's your 30-page report, put it in your desk, and that's it for the rest of your life. It's a starting point, right? It's a lot like you get into an Uber and you say, hey, I need to get to the airport. That driver at some level is going to, you know, traffic is great, then guess what? It's a pretty easy goal to get to the airport. But if there's an accident or a traffic jam, we got to take a detour. And that's what the advisor is there for, is to really be your guide, your financial guide along that financial journey. Now, one thing we have noticed is, and this is a legitimate challenge that most advisors have, is they say, Rob, I get the idea of using passive strategies, right? Trying to beat the market over a long period of time is hard. But one challenge I have is clients will say to me after a year or 2 years or 3 years, saying, why am I paying you a fee? You don't do anything. You don't trade. I don't see any movement in my portfolio. Yes, the portfolio's done well, but essentially you bought these Vanguard ETFs or these BlackRock ETFs or passive funds on day one, and you haven't done anything since. Now, the ironic part of that is that it takes a skill to do nothing, right? It takes a discipline to do nothing, and that's often the best investment strategy. I was online the other day, and one of the best performing investment strategies, when I think it was Fidelity or Schwab, I have to take a look at which one and which custodian it was, but they looked at the data, and some of their best performing accounts by far and away were dead person accounts. So accounts from people who had passed away. And guess why that is? Because they quite simply weren't there to do anything. They weren't able to react to the market. And so I think that says a lot. But as an advisor, how do you justify the fees year in and year out? And that's where the planning and that's where the coaching comes in, right? So passive investing doesn't have to mean passive planning or coaching. There's a lot of things that we can do quarter to quarter to deliver value to clients. That doesn't mean you're in there buying and selling different stocks. And that's what we're going to go through on the next slide. But what we call that is active coaching and portfolio engineering. There's a difference between active coaching and active portfolio engineering versus active investing. They're two separate things. So we want to go through a little bit of that today. So in the active engineering, pardon me. So on the active engineering process, so earlier this year, we introduced our active risk managed sleeves. What does that mean? Well, these are passive ETFs that we use to get to a certain risk number based on a client's risk tolerances, and there's 5 of those sleeves. Now, there's the initial implementation. We found out a client's got a certain number of goals, both short and long term, a risk number, right, and a time horizon. Based on those 3 factors, we select one of those passive risk sleeves. But the planning and the engineering part of it is certainly not passive, right? So this is how it works. We initially start with that initial goal and the time horizon mapping and plan development. That determines what sleeve we want to be in. And this can apply, by the way, it doesn't matter if it's our risk managed sleeves or if you're just using some Vanguard ETFs, you can apply this concept across the board. Number 2, using the market volatility to actively rebalance and tax loss harvest. That sets up a great conversation. You have that review with the client and say, well, what have you been doing as my advisor? Well, you know, Mr. and Mrs. Smith, over the last 3 months, we have accrued about $25,000 in tax losses because we've used that market volatility to take advantage of some of those parts of the portfolio that haven't done as well, and we also actively rebalance to keep you within your risk metrics. Oh, that's great. And those conversations typically go a lot more are more constructive than quite simply saying, well, remember, time in the market, so I didn't do anything with your portfolio. And then lastly, making sure we stay engaged with clients to actively measure their risk tolerances and goals. I assure you, and I know Scott doesn't like me to use those terms, assure or guarantee, but I can assure you that in the thick of the bull market a few months ago, when everything was starting to go up, people's risk tolerances were a lot higher than they're at today. One of the things that we know about risk tolerances is that they're variable and they're not fixed. Pre-2008, everyone liked risk. September 2008, no one liked risk. So we want to make sure we're constantly assessing how the client is dealing with the evolving conditions of the market, having those conversations. Quite simply, giving them a call and having that conversation is going to be worth its weight in gold to most clients. And then, of course, we want to make sure we're updating those goals. And this gets us to, of course, income planning and how we can look ahead of the market and say, you know, it's hard to say whether or not the stock market's going to go up or down in the next month or two. But one area that we can do a little bit more active planning with a higher level of confidence is on the income side. We know that interest rates go through cycles when the Fed is increasing rates, but also cutting those rates. Right now, we're at a very high point in the market. 5.5% is what the current Fed policy rate is on those short-term rates. We've been down at 0 before, just 3 or 4 years ago. We were at 5.25 before we went to 0 in 08 and stayed at 0 for almost a decade. I think that's an important point here. The point of this slide is that rates are variable and they move up a lot and they move down a lot. And it can mean a lot of money for your clients if we are not actively taking advantage of points in time when interest rates can allow us to reduce risk in a client's portfolio, increase their income, and as a result, help them meet some of those retirement income goals while reducing the overall level of portfolio risk. It's a great message that we can go out with. The other reason I'm bringing this slide to everyone's attention today is that, yes, it is more than likely 99.9% likelihood that the Fed is going to cut rates in the next week or two at the next Fed meeting. The only thing we don't really know is it going to be 25 or 50. That does not mean that we lost our opportunity to engage with clients and help them increase their income score. If we look here, once the Fed moves once on the Fed policy rate, they move multiple times down, right? So across the board, we peaked at 5.5 and we bottomed around 1% in 2003. We went to 5.25 and we bottomed at 0, 2.5 to 0, and now we're at 5.5. If they cut by 1/4 of a point, that's only taken us down to 5.25%. The point here is that whether you believe in that neutral rate being at 3 or you think something worse might be down the pipeline and interest rates could go below 3, now is the time to act if you want to lock in some of that attractive income. And even if we go down to 5.25, 5.25% is a lot more attractive than 0 or 1 or 3%. And we're going to show the impact on dollars and cents here in a second. So if we look at a simple Fed policy rate cut of 25 basis points on $1 million account on an annualized rate, that's about $2,500 less income you're going to get as a result of that interest rate cut. Or over 10 years, because remember, income planning is not about 1 year, it's really about 10 years and beyond. That's about $25,000 of lost income over 10 years on $1 million portfolio. Now you're going to say, Rob, that's really not that bad. True, it's not that bad. And that's the point here. We want to take action before the opportunity set gets worse. So if we look at when the Fed has done 3% rate cuts, so in other words, you go from 5 to 2, that's $30,000 or $300,000 over 10 years. Suddenly, that's a big number for a person that's got $1 million. That's 30% of their portfolio. Or if we look at every rate cycle, with the exception of the last one, because we didn't actually get past 2.5%, you've had 4% or greater rate cuts. And that again is $400,000 or $500,000 of lost income for clients that waited. They said, you know what? I want to take my chances on the stock market and see if that comes back, or bonds are boring, I don't need them, or annuities are boring, I don't need them. But you know what's not boring? Is having peace of mind and having that income with a low risk profile that can provide for lifestyle certainty or lifestyle protection in retirement. That's not as boring. And so we want to remind clients that when rates are high and we are approaching that red zone of retirement or are in retirement, it might be a good conversation to have about whether de-risking a portfolio and targeting higher income can make sense. And that's really what the message here is today, is that yes, August went by, record month production-wise for annuities and bond funds and bond strategies, but there's more out there, right? We haven't even hit the first rate cut yet, so we want to stay on message that even if you missed August, even if you missed September, time is still on your side and you can take action and still benefit from higher rates of income. So right now, when we look at our income portfolio, for example, those yield to maturity levels after fees are around 7%. Now, that's not guaranteed. That fluctuates every single day. But that's an attractive, relative speaking, that's an attractive income target that we can show clients. And that's not all that different from other bond strategies out there. It's just a broad example, though, of, despite what's happened with rates, spreads have widened out a little bit, so we can still show some really good yield to maturity levels for clients that are looking to de-risk. Same thing on the annuity side. So annuity rates, they came down a little bit there in the month of August, but I will say rates have continued to come down in September. So we still have a couple more weeks to look at clients that could benefit from a lifetime income stream and an attractive rate structure and take action. So that's your call to action right now, whether you're talking about bond market strategies or you're talking about annuities, is that guess what? The Fed did what I said they were going to do a month ago, and they're probably going to do a whole hell of a lot more of it over the next few months and years. So the good news is, though, we can still get 99% of the benefits that I talked about in August. Let's take some action. So that's the message for today. So the bottom line here is that September, to kind of wrap things up here in a bow, September was a noisy month, but remember, and this is the ironic thing about September, by the way, we always talk about how it's about time in the market, not timing in the market, and how you don't want to let the noise of a market sell-off scare you out of your positions. September could not be a greater example of this. September is the worst month historically for the market. Do you know what the best quarter of the year is? It's Q4. So just a great example and an analogy for what we talk about with coaching. It's like you sell off in September and you miss out the best quarter of the year from a historical perspective. Of course, past performance does not guarantee future results, but from a historical point of view, it has been really stupid to sell in September and to get out before Q4. So we want to instill some of that discipline with clients and remind them that Q4 is seasonally some of the best time to be in the market. Number two, advisors are there to guide and coach and not market time. So when we kind of think of our value add and why do we charge 1%, it's to be that guide, it's to be that coach that really help provide financial guidance through turbulent times. And then lastly, interest rates are still high. Definitely take advantage of it. You can use it as a call to action. Clients can use it as a way to increase income while reducing risk. So with no further ado, I'm going to pass it off to my colleague here, Mr. Scott Rader.
Thanks. Hey, Rob, I don't know if you can just click to the slide after this. I believe it's my slide.
Oh, yeah.
I appreciate that. You're going to be my clicker for the day. Appreciate that. Thank you, Rob. That was a great update. I think some really things to think about for advisors. And like you said, Q4 is just around the corner. And with that, I wanted to just give some quick compliance updates. I have a really brief presentation right now. I just wanted to let everyone know about some things that are coming down the pike and also just some quick and timely reminders as it relates to compliance. So you've heard it before, off-channel communications. This is a super hot button for advisors right now. For the regulators right now. Since last August, the securities, the SEC basically has taken action against 32 firms and basically for what they consider off-channel communications that's resulted in penalties over $439 million. So it's low-hanging fruit for them, and they are very, very focused on that. And basically, what is off-channel communications? It's basically encompasses any discussions or exchanges related to securities transactions or business dealings that are outside the officially regulated channels, so channels that we capture and archive. As a reminder, the approved methods to communicate with clients and staff regarding securities business matters are your approved business email, any approved and disclosed social media accounts, and then we actually have my rep chat now. So if you want to use text messaging, which is pretty much the easiest way for them to really, because they know that clients like to text message, and then you might text message back. We have a tool, my rep chat, that will capture those text messages to those clients, and we have that available. If you're interested in it, please just go ahead and email myself or David Lester, and we can get you some literature on that. It's $20 a month, and it's a solution for you to go ahead and text message your clients. Okay, go back there, buddy. Anyways, yeah, just keep me on track. Again, why this is actually just a brief update is in October, you'll receive, so two things. In October, you're gonna receive your first quarterly certification regarding off-channel communications, and that's gonna come, sorry, I forgot the R there. It's gonna come via the Comply Size system. So we'll assign a certification to you, just like you get annually, that just attesting that you have disclosed all of your methods of communications. And if you have any questions about that, again, please feel free to reach out. I did touch on my rep chat. Again, it's $20. And if you want any information on it, just go ahead and email myself at srader@lifepro.com or dlester, Lester, at lifepro.com. We'll get you some information. Another important update is, I think it's probably one of those things we don't want to talk about, is just the CEs. I know every advisor has a lot of their insurance CEs that they need to complete. We also have now, as of 2024, every state's adopted the IAR continuing education requirements. So California, as most of you are in, they require you to, in order to maintain your securities licenses, to complete 12 hours of CE. And that is going to be 6 credits on products and practices and 6 credits of ethics and professional responsibility. There's lots of places you can go ahead and get that done. You can do, you can use any of the approved CE. So if you're doing most of the insurance, if you're doing it through like, I'm trying to think of one, but like Quest or, I forgot the other one thing. It's like myce.com or something like that. There's a lot of ones that you're doing your insurance through. They will have those courses. Now, the insurance courses at this point also cross over to the IAR education. They're going to be separate courses. But if you're doing your insurance courses there, you can look or call them and see if they have any of the new required IAR, investment advisor representative trainings. They probably do. And those are going to go ahead and you'll put in your CRD number. They'll go into the FINRA gateway, which is what's tracking the education. I'll be able to see it, and you'll get credit for that and be complete for the year. Again, if you have any questions, please reach out to us. But I just want to remind everyone, because it is very important that you get those done. Otherwise, you will be delinquent and potentially lose your state registration. And then finally, just a reminder that the annual compliance meeting will be held in October. We'll send out invitations for that, and we'll dive deeper into a lot of these topics. So I wanted to keep it short here. But that will be in October for the training. Again, that's mandatory for everyone. We will hold a live one so you can ask questions, and then there will be a recording as well. Some of the things on this slide I just wanted to touch on is just as a reminder, you probably got some email reminders about it, but required minimum distributions and conversions as we come into the fourth quarter, those will need to get done in a timely fashion. We will communicate when Charles Schwab puts their cutoff dates to get those done before the end of the year. But I just want to remind everyone, it's always a good thing to just kind of check your list, who needs to take RMDs, who might be interested in conversions, and get those conversations started, and just ensure that you get that to our operations team so they can process those distributions and get those conversions done for you as well. And my final item, as Rob mentioned in the beginning, was the Department of Labor. So the DOL is in kind of as it stands for 2202. It's kind of in in regulatory purgatory, I would say. So right now, the DOL does have 90 days to appeal any decisions. So what we're planning on doing is we're going to continue the DOL form till the end of the year, see where it lands, and then we may take another approach. So in case you had any thoughts on that, any questions, right now, just everything's going to stay status quo so that we don't have any issues if we take action too soon. But of course, we're gonna monitor it and then assess at the end of the year and see if we may shorten that form. We may take other action. So just wanted to let everyone know about that. Of course, we'll talk about that probably in the compliance meeting as well. But if that was on anyone's mind, I wanted to just give a brief update on that. And that's really all I have for you guys. I really appreciate your time. Wanted to keep it short. Thank you. And if you have any questions, please feel free to call or email us. Thank you.
Thanks, Scott. And just want to thank everyone for joining on today's meeting. And I do want to point out, of course, Scott won't mention it, but he is now heading up Simplicity Wealth Compliance. He's the chief of compliance there for Simplicity Wealth. And he's just a treasure trove of information, and he will have access to even more resources. So if anyone has any questions or concerns, or just general guidance that they need on the compliance end, please feel free to reach out to us. We have Scott and David here in the office, and then the entire compliance team over at Simplicity that can, of course, help you support your practice and make sure that everything's getting done the right way as intended by you, the advisor. And of course, the text messaging thing is obviously a big thing. It's something that we've definitely heard a lot about. And it's something that we're trying to make your lives easier to deal with as it relates to the text messaging compliance. So just let us know. But the best solution is if a client texts you, it's always a great opportunity to pick up the phone and have a good conversation with that client over the phone. So anyway, that's what we got for you this week. 888-543-3776. Thanks, Scott, for all your input. And thank you to all the advisors out there that help support our practice. We live and die by you. And if you need any help whatsoever, give us a call. Talk to you soon.